SRP is the company your employer has hired to advise on your retirement plan. This means we consult with the decision makers within your organization regarding your retirement plan design, investment options, compliance measures, and most importantly for today's purposes, individual and group education regarding retirement savings. We believe that everyone should have the opportunity to work toward a dignified retirement. We want to help you do that, especially during times of market uncertainty. You'll want to note that SRP is a separate entity from your record keeper. Your record keeper may be Empower, Principal, Fidelity, or another such company that acts as the bookkeeper for your retirement plan. The job of the record keeper is to track who's in the plan, what investments they own, and what money is going in or out. I mention this because you probably have a username and password for the record keeper site, and there are typically a host of tools and resources offered there. That's important to have on hand. SRP is an additional resource for more strategic help with savings strategies, education, and investment assistance. First and foremost, we'd like to point out that this is a public health crisis, not a financial crisis, similar to what happened in 2008. As a result, market movements and responses may be quite different, but the long-term approach to saving for retirement does not change. As Warren Buffett said, we don't have to be smarter than the rest, we have to be more disciplined than the rest. During difficult times, our first inclination is to do something, when often the best course of action is to do nothing. Statistics show that the best penalty kick strategy for goalkeepers in soccer is to stay in the middle, but they jump left or right 94% of the time. Similarly, if you are 10 or more years away from retirement, the best strategy may in fact be to do nothing. Part of the reasoning behind this is the fact that much of the market's movement, both up and down, occurs in very small bursts. In the 20 years from 2000 to 2019, staying invested the entire time would have seen an investment of $100,000 grow to over $324,000. Missing the best 5 days resulted in returns almost $100,000 less, and missing the best 25 days over a 20-year period actually resulted in a loss of almost 18%. Remember, this time period included the dot-com crash, 9/11, and the 2008-2009 financial crisis. Our natural tendency toward action typically spurs us to move at exactly the wrong time. In fact, going back over 25 years, the average 3-year return for investors buying when others were buying was 6.7%, while the return for those buying during periods of greatest weakness was 11.8%. Those that bought during the dark days of the 2008 financial crisis saw a return of over 88% in the next 3 years. Because of time to time the market, the average investor trails the returns of the markets. This is sometimes called the irrational behavior gap. Over the past 20 years, the average stock investor has trailed the market by almost 2 full percentage points, while the average bond investor did even worse, getting almost no return, while the bond market had an average return of over 4.5%. Timing the market is especially hard because investors have to be correct on 2 consecutive decisions, when to get out and when to get back in. Historically, this has been extremely difficult to achieve. It's not just the average investor that has trouble predicting the future. When asked to predict interest rates, Wall Street experts would have been better off flipping a coin rather than trusting their own judgment. As our old friend Yogi Berra said, it's tough to make predictions, especially about the future. We know that headlines sell. You don't have to look far for headlines that try to foretell future events, and often in a gloomy way. But hindsight is 20/20, and we now have had the luxury to look back at some of these famous, shocking headlines and see that, when given some time, things actually played out much better than expected. Business Week's cover story in 1979 announced the death of equities, but the S&P 500 showed life over the next 20 years and rose nearly 2,400%. And more recently, Time magazine claimed the new hard times during the 2008 financial fallout. Since then, stocks rallied more than 300% over the next 8 years. Scary headlines have been around for years, as have bumpy times in the market. Rather than getting consumed with fearful and shocking predictions, spend your time preparing for a long-term ride that is equipped to handle the inevitable ups and downs of the market. It seems like everyone is saying things like, let it ride, stay the course, and don't take action. But what if that feels much too passive and you're looking to be a little bit more proactive? Many investors want to act. This is a natural human response. There are indeed a couple proactive measures you may want to consider taking at this time, but they don't necessarily include overhauling all of your retirement plan investments. First, examine your emergency savings. It's always important to have an emergency account with 3 to 6 months of living expenses readily available, but even more paramount during times of market and economic uncertainty. If it's been a while since you took pen to paper to calculate your short-term needs, now's a perfect time to do just that and prioritize funding any shortfall. Second, reassess your long-term appetite for risk. It's easy to be an aggressive investor when the market is seeing double-digit returns. Conversely, it's quite popular to be conservative when the market's down. But these are circumstantial strategies. It's important to reevaluate your long-term risk profile regardless of market conditions. From time to time, there are many helpful risk questionnaires out there. We're happy to provide one if you need it. Email us at plantoday@srpretire.com. Commit to your retirement savings plan. You've heard us say it time and time again, stay the course. It can feel passive, but deciding to stay committed may be the most important action you take. Staying committed to a retirement plan, both contributions and investment strategy, during times of volatility can have positive long-term implications. Even including downturns, the S&P 500's average annual return over all 10-year periods from 1937 to 2019 was 10.47%. Fourth, talk to a financial advisor. Thinking of making a change? Talking with an advisor can be especially helpful for perspective if you're considering a change. It's our goal to help all of our retirement plan participants find a strategy that will lead to a dignified and graceful retirement. It would be our privilege to speak with you about your plan, help alleviate concerns, or make adjustments if necessary. Please let us know how we can provide support. At SRP, our mission is to help ensure all of our participants have the ability to retire on their own terms. The recent market turmoil is unsettling and does provide the opportunity to evaluate whether there is the appropriate level of risk in your investments, but we encourage you not to make any rash decisions based on what some alarmists might say. If you would like to speak with someone in more detail about your personal situation, please reach out to us at 866-SRP-401k extension 1. If you get a voicemail, please leave your name, your employer's name, so we can get you to the appropriate regional contact within SRP. Thank you for joining and encourage you all to prioritize your health and safety in the weeks ahead. Be safe.